Have you ever wondered what questions you should be asking your lender before getting a loan? And you might think it's all about the interest rates, but there's so much more to it. For many of us, buying a home is the most expensive purchase that we're ever gonna make. And with most people only buying 1 or 2 properties in their lifetime, understanding how loans work can be a complicated process. But don't worry, I got you covered. In today's video, I'm gonna guide you through the essential questions that you need to ask your lenders to get the best deal possible. So by the end of this video, you'll know the way around the loan process, making sure that you don't get stuck with extra fees or higher rates. And if you're just starting your home purchase and you're wondering how much you need to save to buy a home, then check out this free worksheet that I have to help you create a savings goal to figure out how much you need to save every single month, which you can grab in the description below. It's a great tool that can help you plan your first home buying journey. So let's dive in. Now, the first question you should ask your lender is, what are your processing fees? Lenders often don't give out loans for free. There's a lot of paperwork and people involved, and lenders charge a processing fee to help create a loan for you. Now, this fee is separate from other fees that you might pay, such as your appraisal fee or an inspection fee, and it's also different from discount points, which we're going to discuss later. This is just a flat fee that a lender is going to charge you whether your loan is for $500,000 or $100,000. Typical processing fees are going to be between $1,000 and $2,000 per loan. And the thing about these fees is that these are one of the most negotiable parts of a loan because this is something that the lender determines directly. So if they like you enough, or if you have a special enough relationship with your lender, then they might waive part or all of this fee. So it's another way for you to compare your total loan costs with another lender. Now, the second question that I like to ask is, what are the interest rates and how do discount points affect those rates? So when you're comparing lenders, everyone might offer you a different interest rate, but some lenders offer a lower interest rate with some discount points baked in already. So discount points are when a lender offers you a lower mortgage if you agree to pay more money upfront today. So lenders use this as a hedge in case rates increase in the future. So as an example, let's say interest rates are low today and they give you a 30-year mortgage at 3%. Then a year later, interest rates increase to 7%. If that happened, the lender's gonna feel bad because they already locked their money away with you for 30 years at a low interest rate. So to hedge against that, lenders like to guarantee more profit by taking your money up front in the form of discount points so they can lower your overall interest rate. So going back to what I was saying earlier, when a lender offers you a lower rate but charges you discount points, it just means that you're just buying down your rate. So what you want to do is when you're asking for a quote is to always make sure that you're quoted based on no discount points being applied. By getting a quote this way, you'll be able to compare the baseline rate between every lender that you shop around with and can compare apples to apples. But on another note, it's also good to know how the discount points affect the interest rate. You can ask them questions like, how much does it cost for me to lower my rate down by 1/4% or 0.5%? Because if you can pay $1,000 to lower your rate down by 1/4%, then it may save you tens of thousands of dollars over the lifetime of the loan. Now, as a counterexample, you can also lower your total closing costs by agreeing to have a higher interest rate. In fact, I actually did this when I was first buying my investment properties. So instead of getting a mortgage at 5%, I would ask the lender for a 5.25% mortgage rate because I knew that the lender would credit me back $3,000 to $5,000 that could be applied to my closing costs. So make sure you ask them the question. The third question you should ask your lender is, how much do I qualify for? You definitely need to know exactly how much you qualify for based on your savings, your debt to income ratio, and your credit score so that you can determine what you can buy in the first place. You never just want to show up to an open house or property and assume you can buy something only to get held up in the loan process and lose your dream home because you didn't get the numbers right in the beginning. So to answer that question, your lender will ask for your W-2s and your tax returns for the past 2 years so they can verify that you've had good employment history. They're also going to run a credit check to see if you have good credit and if you can qualify for the loan in the first place. They're also going to want to ask you for 2 months of your most recent bank statements so they can see that you have enough liquid funds to close on the deal and pay for the closing costs, as well as having 6 months of reserves to pay for the mortgage. Based on that, they'll be able to give you a pre-approval letter for you to start writing offers with. Now, the fourth question asked them is, can your lender even lend in your target location and for your specific property type? Different lenders have different regulations, and if you're looking out of state for rental property, then the lender that you're working with needs to be licensed in that state. And this can be a problem for some smaller mortgage brokers who are only licensed in one state and can help you with your deals in another. Some lenders may cover most of the United States, but be limited in other states because of the strict regulations. For example, Nevada requires you to have a physical office in that state for you to do loans there. And Louisiana has some very strange lending laws. And as far as property type goes, most 1 to 4 unit properties are going to be packaged and sold off to Fannie Mae on the back end. So this makes it pretty simple to underwrite and are easy to get a loan on. But if you're looking to purchase a commercial property, such as a 5-plex or above, then a regular bank or lender may not be able to do that loan for you. You'll need to get a special non-QM loan or commercial loan for that. Another property type that may not qualify for a conventional loan is if the property is in really bad condition, such as a fixer-upper. So make sure that you ask your lender what condition the property needs to be in before they can give you the loan. And Hint, hint, if you guys can't get a loan with a conventional lender, you can always use a hard money lender to help you close on the property. Now, the fifth question to ask your lender is, how long is the rate lock good for? So if you ask your lender, hey, thanks for quoting me at 4%. If I don't close for 2 years, will you still give me that rate at 4%? And the most likely answer is going to be no. The rates fluctuate every single day, and most lenders cannot promise you this rate for that extended period of time. But most people don't like uncertainty. So lenders often offer to lock your rate in for a short amount of time. Sometimes it could be a month, sometimes it could be 3 months. But if it takes longer to close than that, then your lender may have to reset your lock to the current rate. And if rates have jumped up, then it's too bad. You're not going to be able to close with that lower rate. Another thing to note is that most lenders will not lock your rate until you are actually under contract and you tell your lender to lock it. So one of the most important things to do once you get your property under contract is to call your lender and tell them to lock the rate ASAP. So locking rates is very important, but there's another cost that you need to be aware of, which is your total closing costs. So question number 6 is, what are your total closing costs? When you're purchasing a property, you need to have more than just a 20% down payment saved up. There are also closing costs associated with it. Now, these surprise costs remind me of a time when I was a little kid and I was going to the mall and I went to a magic store. And there was this young kid who wanted to buy a magic toy that she saw that was on sale for just $5. And she went to the cashier, had the toy in hand, and gave him a $5 bill. And he was like, ooh, the total is actually going to be $5.45 because of the taxes. So you need a little bit more. And the girl was confused and kept pointing to the $5 and kept trying to hand him the money. And he's like, look, I'm sorry, I can't sell this to you unless you come up with the tax money. So that's the same thing with properties and their closing costs. Yes, you do need to come up with a down payment as your contribution to the property, but there are other costs associated with doing the deal in the first place. So as I mentioned before, these closing costs can include processing fees from the lender, discount points if you choose to buy down your rate, fees for the title and escrow company services, surveys, possibly appraisals. Sometimes they're even going to add in prorated property taxes. And if you're getting a mortgage and you're closing in the middle of the month, then most lenders will charge you the prorated amount for the rest of the month. So all of these costs are calculated by the escrow company later in the process, but your lender should be able to give you an approximation of how much you need to close on so that you know how much you need to save beforehand. As a general ballpark number, I budget 2% of the purchase price as general closing costs. Like I mentioned earlier in this video, I made a free worksheet that you guys can use to help you create a savings goal to figure out how much you need to save each month to buy a house. You can pick it up and you can get it for free with the link down in the description. And the final question to ask your lender is, how quickly can you close? Some lenders are going to sound super great and offer you a really low interest rate, but deep down inside, they know that they're so swamped with their understaffed team that their processors and underwriters can't close on your deal for at least 40 days. Because of that, you may lose the deal. So you need to know what their pipeline is and how fast you can close, because if they can't close on time, then there's no point in even using them. One thing that I found to be very helpful when it comes to getting your loans done quickly is that the squeaky wheel gets the grease. And if they tell you that it'll take 45 days to close on your loan and you wait 45 days to close on your contract, then what's probably going to happen is they're going to take your file, put it on the bottom of the pile, and neglect your loan for at least 30 days. Then on day 43, they'll finally look at your file and say, oh, we actually need another 10-day extension. This has happened to me countless times and it's super frustrating. So what I actually tell my lenders now is that a 45-day close is extremely unreasonable. So I want to work with them, but we need to be able to close in 25 days. And more often than not, they'll be willing to make the exception and they'll try their best to put it on the top of the pile. So meanwhile, you can tell your seller, look, I'm going to write down 25 days to close, but deep down inside our hearts, let's assume 35 days. So this protects me so that they don't go crazy on me if we happen to not close in 25 days. So these are the questions that you should go and ask your lender when shopping for a quote. And this way you're going to understand the full picture of what they can offer and will be able to ultimately decide who to go with. Now, getting the best loan rate is a great way to kickstart your real estate journey, but if you want to know the best way of getting started with real estate, you definitely want to check out this video over here. Thanks for watching the video, guys. I appreciate you and I'll see you next time. Take care.